Joining me now are traders Scott Fullman and Dutch Masters. Gentlemen, thank you so much for joining me in the second to last day of trading. We've got green lighting up the screen right now, which we love to see. Scott, I want to start with you. Okay, so we are seeing that rally today, but this is going to be the first time in likely, 4 years that these benchmarks are going to be ending the year on the downside. We saw the jobs data come out today that does ease some of those rate hike fears. What are some of the indicators that you're looking for in the next quarter?
Sure. Thanks, Kelly. Well, we're looking at a number of things. First of all, fact is that the market has been beaten up pretty good. And, year to date, the S&P is still down close to 20%. The Dow is down 8.5%. NASDAQ's down 26.5%. And there's a lot of issues out there that have been beaten up. But we're watching, we want to see exactly how businesses are going to operate going into the new year with the Fed still tightening. And I'll tell you, the fact is that they're probably going to over-tighten because that's usually what they do. But usually we'll see stocks pick up, but we think that it's going to be a rough first and possibly second quarter before we actually see things really start to turn higher into the second half of the year. And I know Dutch, I think he agrees with the same thing. But the fact is that when we're looking at the indicators, we're not just looking at the unemployment numbers. We're looking at inflation. Obviously, that's a major, major concern still with the Fed out there. And we're also looking, to see how GDP is going to come in for both the fourth quarter and the first quarter of next year. That's going to tell a lot. We think also retail sales, something that has to be watched. We're not sure that this was such a great holiday shopping season.
Yeah, sure. Though I suppose if you look at my credit card, it would look like it was a great holiday shopping season. But yeah, to your point, there's a number of indicators beyond jobs. Of course, China also will play a role as they come out of this COVID lockdown. Dutch, I want to get to you specifically about the S&P 500, because we've seen this all over the place this year. Back a couple of weeks ago, mid-December, had a bear market rally, hit about 4,100. Do you feel like we're finally starting to normalize, though, in the numbers that we're seeing now, and what might you expect it to drop to come next quarter?
Right. Thanks, Kelly. Yeah, we've been short off and on, but mostly on all year. So we had a pretty good year from a performance standpoint. The S&P has been in a clear downward sloping channel. We get these really wicked rips to the upside. In these bear market rallies, they can be quite violent, and they can happen over the course of just one day, like today, and the last one that we had was a one-day rip to the upside. I don't know if we're going to get any follow-through here, tomorrow and into next week, but I completely agree with my compatriot here and my comrade on Wall Street. I think we're going to have a really bad Q1. We're just now beginning to see the index dive back down into the channel. Today is a, one-day rip, I think, in my opinion. If I was worried about my short positions, which, were very short, I wouldn't be booking a massage over at the Canyon Ranch Spa today, which I'm going to go to after this. So I'd be on the screen. I think we're going to see... I know, free plug, right?
Yeah. Well,
I think we're going to have. A S&P off another 15%. The DQs are going to go off another 20. We're going to see some accelerated selling. We've already begun to see it because the Nasdaq was off like 10% or something in the month of December alone. That's a horrible year, and it happened in just 1 month. And so I think the acceleration and panic selling is just about to start here.
Yeah. Well, now I want to dive into some specific sectors, though, because, as our viewers think about where to put their money. Scott, you're hot on the consumer staples sector, specifically P&G. Tell me a little bit more about that.
So, from a technical and macro standpoint, when you look at what's happening in the marketplace, you want to be defensive. And one of the sectors that's in that defensive grouping is the consumer staples. And what we've been doing is searching out stocks in that grouping that are outperforming, that are leading, and Procter & Gamble is one of them. We're looking right now, we have a first measured target on it of $177, which gives it about 16% upside from here. And in addition to that, it has a yield of 2.4%. So investors will also get a little bit of buffering as well as a little bit of aid from the dividends paid by P&G.
Yeah, I'm just looking. I mean, it's down 6.3% for the year, up a fraction of a percent, but that's certainly one to watch. Now, Dutch, your performance this year, portfolio, 321% on the upside year to date. That's very impressive. It sounds like you've been doing a lot of short selling. Tell us what you're thinking about for this next quarter. I hear rumors that you're short on real estate.
Yeah, so I think that a lot of the short money, the easy money on the short side's kind of been made, okay? And we rarely have a year like this where you can short consistently and make a lot of money. This is a very rare thing. However, we don't believe that the real estate market has properly adjusted to the downside given the new rate regime that we're under. The cap rates haven't come in enough. We're just now beginning to see all of the data come in over the last couple of months, and the real estate, showing that the, home sales have basically gone to a freezing stop. We have a lot of guys that we are in touch with in the home building area, and that they had goals of selling 25 homes in XYZ market, and they sold 0, or they sold just a few. I mean, it's over there, okay? So we use an inverse ETF, DRV, but we also go short directly to home builders like LGIH, LGI Homes. And the reason is we know LGI markets to the first-time home buyer and offers all kinds of no money down incentives. And with this new rate regime out here, none of their clients are going to qualify for, in our opinion. So we've been shorting that from about 102. It's down around 93. We shorted SLG at about 39. It's down around 33, 32. We covered that SLG short after just a few weeks down to 32 and a quarter. So, but we think the real estate market has a lot further to adjust down. We think the Dow, the S&P, our target's about 32.10. So what are we, a good 400 or 500 points away, right?
Right. I mean, it's a good point that you make about the first-time home buyers. We've gotten a lot of housing data that we're going to get into later in the show. Gentlemen, thank you both, Scott Fullman and Dutch Masters. We appreciate you being here with us today.
Thank you, Kelly.
Thank you, Kelly.